Welcome to our first chapter in international finance. Today we're going to talk about some of the complexity that firms face when they deal with international business opportunities or when they expand internationally. We'll talk about global capital markets, which are really a key component to doing business internationally. Whether it's directly selling physical goods and services abroad or arranging the financing for those activities. We'll touch on why international finance works, motivating it by this theory of comparative advantage. And we'll also talk about why international finance is different than the domestic finance that you've learned so far. We'll talk about how some multinational firms that do business in multiple countries at the same time, can sometimes identify imperfections in global markets and translate those into opportunities for additional profit. We'll talk about the general process by which a firm starts out domestic, but gradually, over time, expands its business activities abroad. The process, in other words, of becoming a global firm. First, I want you to stop and take a minute to read this commentary here in italics. Note who it's written by. It's the CEO of Procter & Gamble, one of the biggest consumer goods firms in the world. And where this is taken from is the quarterly report of Procter & Gamble. They're talking here about December 2014, that quarter ending. And note that he says here, while we continue to make steady progress on the strategic transformation of the company, in other words, while we continue to make money and do well fundamentally, that considerable business portfolio, product innovation, and productivity progress was not enough to overcome foreign exchange. In a nutshell, P&G had a loss for that year as a result not of all the wonderful business it did, but as a result of receiving that business in foreign currency. As a result of that foreign currency weakening, they ended up actually losing money in dollar terms. We'll talk about some of the mechanics of how that all works later on, but the point of this paragraph here is really just to motivate the additional issues that you have to think about in international finance. One of the biggest issues when it comes to that is the effects of currency values. Currency values are a big issue for global firms, multinational enterprises, or MNEs. These firms that operate branches, subsidiaries, that is, smaller sub-companies located in foreign countries. There are some big trends we see in financial globalization these days. One is that there's really a mix of floating and managed exchange rates. That is, different countries do different things with their currency. And in the currency markets themselves, traditionally, the US dollar has been the most ubiquitous, the most common currency out there. But we see more and more the Chinese yuan becoming a significant factor in the currency markets. Another consideration that's affecting international finance is large fiscal deficits. Now, especially after COVID-19, but even before then, countries were borrowing significant amounts of money. In what currency they borrow and how much they borrow impacts both interest rates and the value of currency itself. And every country faces this. Every country raises debt. Every country has interest rates. And so all of these things sort of interact with each other to change the value of one currency versus another. Other aspects that we'll talk about later are these balance of payments imbalances, that is, differences in the level of trade between countries, the fact that many firms are not actually held by the public, that is held through the stock market, but are privately held, owned by families. Or if not families, a small group of individuals. And emerging markets over the last 15 to 20 years have been more and more a consideration in international finance. So we can broadly break down this whole set of concepts in international finance into three different categories. You have assets, institutions, and linkages. One of the biggest assets in international finance are debt securities. The US sells debt securities. These are called treasury bonds or treasury bills or treasury notes. It's IOUs issued by the government. In this case, the US government. But every country out there sells its own debt securities. And those securities are sold in the currency of that country. There are equities as well and all sorts of other types of assets like real estate, but the sort of the baseline security, the biggest impact, are the debt securities of the country itself. Institutions are another dominant force in international finance. These are the central banks, like the Federal Reserve in the United States. Each country has its own central bank. Commercial and investment banks. Commercial banks, those banks like Bank of America and JP Morgan, they take deposits. Each country has other major commercial banks that are similar. HSBC, BNP Paribas, Bank of China. These are private or semi-private institutions that exist to lend money to firms, take money from savers, generally just facilitate the whole global financial system. And those facilitations occur through linkages, that is, these interbank networks for currency. Currency is not traded on one big market like the US stock market, for example. Instead, currency is traded in a distributed fashion from bank to bank and is often linked to underlying transactions like trade or the sale of or purchase of securities. These linkages make trade possible. We can see these linkages here. Central banks, other institutions, private banks, commercial investment banks, all facilitating the exchange of currency and trading with each other in something called the interbank market. LIBOR is something we'll get to in just a minute. These banks are selling debt, raising debt, selling equity, raising equity, providing loans to consumers to buy houses, loans to businesses to expand. The difference being from what you're used to is that all this is happening internationally. One bank in one country may sell debt in another country and then go on and lend it to consumers, take the proceeds of that debt and lend them at a higher interest rate to consumers in their home country. This type of complex global interrelationships is stuff that we'll look at all throughout this course. This is international finance. Now, currencies, as I mentioned before, are a huge part of international finance. So the first thing that we need to do is really understand currencies. We typically quote currencies against the dollar, as in so many Japanese yen per dollar. For example, 111 Japanese yen per $1. If I had $1, I could exchange it for 111 Japanese yen. Now, in some cases, there are some currencies out there that are quoted in dollars per unit or dollars per, for example, euros. In these cases, we put not the dollar on the bottom like we did with the yen, but instead on top. And so there we have 1 euro, for example, buying $1.25. Whether we choose this convention or this convention really just depends on custom. Typically, with a lot of European currencies, we'll see the euro or that currency on the denominator here and the dollar on top. Whereas most other currencies, the dollar is on bottom. $1 buys X amount of whatever other currency we're looking at. Let's make this a little more concrete by looking at some actual currency quotes. Let's take the Argentine peso to begin with. It has a symbol, just like the euro has a symbol or the pound has a symbol. And it also has something called an ISO code, this 3-letter code. Most of the time in currency trading, we use the ISO code because it's friendlier with computers than characters that you see here with the typical symbol. The 3-letter code is more standardized. In fact, ISO stands for International Standard Organization. Here we see pesos per dollar, 8.78 Argentine pesos will buy $1. Taking our yen example again, Japanese yen, the symbol for yen is what you see here, and the ISO code is JPY. This 119.765, $1 buys 119.76 yen. We could go on and on with this really. There are a lot of different currencies out there. A couple ISO codes I might draw your attention to are that of the United Kingdom, the British pound, and its associated symbol, and the euro, a currency that's used by a number of different European countries with its associated symbol and ISO code. Note here that the euro, at least at the time of this publication, is less than 1. So $1 buys 0.915 euros. Let's zoom in on that for a moment. Remember, I said with some European currencies, we often have it the other way around. That is, we often have the US dollar per that currency. Or 1 euro buys X amount of USD. So we can either write it like we see here, listed here, or if we want to write it the other way, the conventional way when it comes to European currencies, we can divide by that top number, 1 divided by that top number, and get it the other way around. 1 euro buying $1.093. Either way is okay. We just need to be careful when we're doing it to keep track of which one is in the numerator and which one is in the denominator. But remember, you can always go from one to the other by doing this 1 over x trick. I'd like to talk about is the euro currency market. Now, just so you know, euro currencies, the word euro currencies, has nothing to do with Europe, or the euro for that matter. I didn't make this up, it's just the way that convention has evolved. Basically, a euro currency is this: any domestic currency of one country on deposit in a second country. You could have, for example, Japanese yen on deposit in a bank in the United States. Or you could have US dollars deposited in an account based in London. Both of these options are euro currencies because it's a currency on deposit in another country. Surprisingly, the euro currency market is a very big market. It's very common to deposit currency in another country. Think about this from the perspective of a global company. Maybe they're based in the United States, but they have operations all throughout the world. They have sales that occur in the United States, but they've also got a sales operation team in Europe, and they also sell to customers throughout Latin America. It's pretty much impossible that they could use US dollars at each one of their subsidiaries. You couldn't, for example, sell sodas to consumers in Latin America and expect to receive US dollars for them. You'll have to sell them for whatever currency is operating in that particular country. And suppose you do sell for that local currency, for example, Mexican soft drinks in Mexican pesos, you wouldn't just immediately always convert your sales from that subsidiary to US dollars and bring those back home. You may have suppliers to pay in Mexico. You may have labor to pay in Mexico. And therefore, you have a need to have a bank account in Mexican pesos. It's possible you have an account in pesos with a Mexican bank there, but it's more likely that you have a number of accounts in different currencies in one single banking location with one or just a couple of your best bank partners. In that case, you need to hold some amount of Mexican pesos in an account to pay your suppliers. It's a temporary place to park your cash. You park it in Mexican pesos, but you may park it in a Mexican peso account over at, say, HSBC, located in Hong Kong. With that bank, HSBC, over in Hong Kong, you may have other accounts in a number of different currencies. This is the sort of complex financial operations that characterize a large multinational firm. Dealing with this complexity as a financial manager is something that you're going to learn in this course. So, that's the euro currency market in a nutshell. But there's one more very important thing to talk about related to the euro currency market, and that's this thing called LIBOR. Because we have these locations where you have these different bank accounts in different currencies, those bank accounts, that cash is just sitting there, held by a bank. And what do banks do when they hold deposits like that? Naturally, they begin to lend that money out. And so therefore, the euro currency market is not only a place to park cash, it's a major source of borrowing for global corporations as well. Borrowing involves interest rates. And when it comes to these euro currency markets, those interest rates are wrapped up under something that's called LIBOR. It's the London Interbank Offered Rate. And you can think of it as like a baseline interest rate. It's the interest rate that one bank will lend to another for a relatively short period of time in that particular currency. So let's go back to our example here, HSBC in Hong Kong. Hong Kong is an offshore financial center. Let's say we just have two banks based in Hong Kong, HSBC and Goldman. And here's the amount of yen that each bank has on deposit. So corporations are depositing yen with both HSBC and Goldman. Suppose HSBC's yen pile grows. Corporations started to deposit a lot more money with them. And at this point, HSBC has a surplus of yen in its deposit accounts, more than it really knows what to do with. It might have some opportunities to do something with it in the long run, but in the short run, it's just too much capital. And why don't they just temporarily lend it to Goldman? Goldman may have a much smaller amount of yen at this point, and they need to borrow some more. So what happens is that HSBC maybe borrows or lends temporarily a certain amount of yen to Goldman so that Goldman can make use of it. That lending comes at a certain interest rate. Maybe because it's the yen, and it's a certain size that's being lent, HSBC may only charge Goldman 1% per year for this extra amount of yen that's being lent. And then Goldman will give it back in a year. Essentially, that interest rate there is LIBOR. That's the yen LIBOR for a 1-year interest rate. In reality, it's not just HSBC and Goldman. LIBOR comes as the average of a number of different interest rates from one bank to another. But every day, there's this agency that's keeping track of interest rates at different maturities that are being lent from one bank to another. LIBOR is heavily used, and the interest rates are low because it's one bank to another. Banks, on average, are pretty low risk, especially for these short-term loans. So what happens is that LIBOR, for a particular maturity and currency, generally becomes a sort of baseline interest rate that's used in many different financial contracts that are out there, such as loans, but also financial derivatives.
And so when a bank wants to give a loan to a company, what they'll charge is that base rate LIBOR, whatever it is, plus some sort of interest rate on top. Because they're giving a loan to a company and not another bank, and so there's more risk involved. But you can see that the base component here, this part might change depending on who they're lending to, but LIBOR becomes this base or reference interest rate that makes up most, if not all, loans out there. We will talk about LIBOR in subsequent units, but for now, just recognize that it's a very common reference rate, interest rate. Let's talk about some differences between regular financial management, such as those that the concepts that you might have learned in earlier corporate finance courses, versus international financial management, which is what you're learning here. Really, there are a whole bunch of different factors that you have to consider in reality when you're doing business internationally. There are the obvious ones like culture and history and how those play out into differences in business practices across the world. Same thing with corporate governance. But a lot of the stuff that we're going to focus on in this course is the differences in foreign exchange or currency factors and how political factors affect foreign exchange and interest rates across different countries. We'll see that these different factors also impact demand for investment in different countries. One country might look more enticing as an investment because of lower political risk, for example. That in itself might increase the value of that country's stock market as more international investors go and invest their money in that country that they feel is a safer bet. So it gets very complex because you have all these additional dynamics to think about in international finance. And some of these risks we can actually reduce, if not entirely eliminated, through what's called hedging. And so we can use some financial instruments that may be new to you, but are pretty common when it comes to eliminating risk in an international finance perspective. So we can use these types of things, derivatives, for example, to eliminate or reduce exchange rate risk or reduce our equity exposure to a particular country. And a lot of this complexity actually presents opportunity for firms. In a way, this is how multinational enterprises thrive. They strive to take advantage of imperfections in national markets for products, that is, things that get sold, for factors of production, that is, the stuff that goes into the manufacture of those assets, and for financial assets themselves, stocks in different countries, bonds in different countries, and the rate of interest. Sometimes it may make sense, even as a US firm, to not borrow in the United States, but borrow in another country where interest rates are cheaper. You have to deal with the fact that in that case, the borrowing is in a different currency, but if you can hedge out that currency exposure, you might be able to get a loan that's cheaper than if you had just simply got a loan here in the United States. The biggest firms, the biggest international firms, are best able to take advantage of these types of opportunities because, like anything in business, scale can be a benefit. If you're really good at raising money, then having more opportunities to raise money by having more access to capital markets in other countries, then you as a finance manager are better positioned than finance managers at firms that just focus on financing in one country alone. Likewise, if you can sell your product not just in the United States, but you can sell your product all throughout the world, think of the economies of scale that can arise as a result of that. You can have one gigantic manufacturing base. Samsung is an excellent example for manufacturing cell phones and other technology. They have one manufacturing base that's very expensive, that's very technologically advanced and hard to compete with. Other firms can't really deploy that type of capital to that level of advanced manufacturing. And yet Samsung, because they can sort of finance this large production base through the sales of revenues of cell phones all throughout the world, they can reap this competitive advantage of having really great technology. It's very expensive to research and produce, but they can spread those research and production costs out across a whole bunch of units, across a whole bunch of cell phone sales. So by having a global reach for their product, they can have a competitive advantage when it comes to technology and research and development. That's just one example of how a global company, an MNE, can take advantage of market imperfections. And companies engage in multinational business for many different reasons. Samsung, for example, was to have a really great technological product, but to sell to as many people across the globe as possible. Other MNEs have different sort of motivations for going abroad. I mean, some might be multinational, but they might be multinational mining firms, and they might find that mines in Australia are more or less the same when it comes to mining as they are in South Africa. And so they might seek to exploit their ability to extract material from the earth across a number of different countries. These are international firms motivated by the search for raw materials. Other multinational firms might invest in another country because the country that they're based in currently is too politically risky. It could happen, for example, that the court systems, it's too easy for certain powerful groups to take advantage of the court systems so that they can expropriate the assets of that company. That can be a real issue for some companies in some countries. And therefore, they will take the assets that they've got in that country and move them to another country where it's politically safer, where the assets are more secure. That's another motivation for why a firm will go international. And another reason is that different countries tend to have different types of workforces. Some workforces have different technological skills than others, or have different production capacity than others. If you're going to, for example, create a textile manufacturing firm, finding workers in the United States is probably not going to be the best idea. However, if you're going to create a finance company, or if you're going to create a web software engineering firm, you're trying to become the next Google, for example, then San Francisco or the United States more generally is probably going to be the best place to do that. So you'll see that here in the Bay Area, a lot of international firms have offices in the Bay Area, and the offices are geared towards identifying venture capital opportunities, identifying ways to grow their technology investments. And these will be companies like Germany's Siemens, for example, who does all sorts of different manufacturing and engineering. They have a base in Menlo Park that specializes in identifying small tech companies that they can invest in here in Silicon Valley. They do that so that they can innovate with all of their existing products, that if a new innovation comes out of these venture capital investments, they can apply that knowledge to a lot of the other products that they have already. So the search for local talent is another reason for international investment. And of course, these aren't mutually exclusive concepts. A company might seek to do international investment because it wants to sell more products there, but it also wants to seek political safety, or it also wants to seek additional intellectual capital ability along with selling products there. Whatever. These are all just different potential motivations for a firm to do business in another country. So the process by which a firm becomes a global one isn't really that premeditated. In fact, it often happens almost by accident. And we see it in these stages, essentially. Basically, you have a firm that starts off selling domestically. I mean, maybe they just sell shoes domestically. And they start realizing that they could sell shoes, say if they're in the United States, they could start to sell shoes to Canadians and people in Mexico. So all of a sudden they start reaching out and selling internationally. They start exporting. But then they realize, hey, maybe it's cheaper if we manufacture these shoes in Mexico or in northernmost Canada, and then use that as our manufacturing base and sell to the rest of the continent. And there they are, deepening their international integration. And before you know it, they may decide that, well, let's do a manufacturing base in Asia. And heck, while we're at it, I mean, look at the distances. Maybe we should sell to Europe as well as North America. And now we need to finance that expansion. And maybe we should raise money, but why should we just raise money in the United States? I mean, if interest rates in Japan are super cheap, then maybe we should borrow in Japanese yen, take that money and use that to build up our production capacity. And so really, before you know it, a successful firm just invariably becomes an international one by the process of deepening their supply chain and extending the customers that they can sell to and finding alternative sources of capital structure. That's really how the globalization process works. And in the textbook, if you'd like to take a deeper look into this concept of becoming an international firm, there's an example of a firm that will be our poster boy for international finance for the rest of this textbook, called Ganado. The textbook sort of gives a story of how Ganado starts out as a domestic firm and gradually expands its foreign presence and becomes more and more of a complex international corporation.